Hello everyone, this is Matt Curfman from Richmond Brothers here with the November edition of Matt's Minutes. I'm recording this a few days into the month of December, and today happens to be the day that the markets are closed in honor of President Bush. And so what I did is ran some charts, and I want to take today to give some perspective, really going back to the end of the third quarter, which would have been ending around September 30th, or the fourth quarter starting October 1st. You know, there's a few words really we just wanted to acknowledge. One is it's been choppy, it's been a roller coaster, and right now it probably feels like we're going down the hill but we're not coming back up. The last 2 months have been incredibly choppy and incredibly uncertain in the overall marketplace. And so one of the things you may be able to see on your screen, or we'll send with the video, I did some charts just to say how did the broad markets dip and what happened basically between September 30th and then December 4th, which was the day up to this recording. And then also wanted to infuse as an alternative, how did some of the really big names do, the Facebooks, the Apples, the Amazon, Google, Netflix, those sorts of things. We've just seen really big swings in all companies and by and large in all equities. So outside of equities, if you had cash, money markets, CDs, guaranteed annuities, or low duration bonds, those are really the asset classes we haven't seen much movement on in the last couple of months. And that's really where hopefully some safety nets are. And ideally those are places where whenever possible we're using those assets to draw income from and not hope to depend on the equity side of things. So again, if you look at the charts that we're including between September 30th and December 4th, that happens to be the day of yesterday before the markets were still open. You look at the broad markets and we've seen anywhere from -5% to -11%. And those are on things like the Dow Jones, NASDAQ, the S&P 500 as an example. If I then included the Facebook and kind of what are called the FANG stocks that I mentioned earlier, you see in the same period anywhere between -5 and -26% with some of the biggest names out there. And you know, I just have to say that what that tells us a little bit is there's a lot of emotional driven investment decisions right now. And when a lot of emotion gets involved, you see lower lows, and in good times you see higher highs, but right now that's not what any of us are feeling. So it's been choppy, it's been a roller coaster. We want to basically be able to come back up the hill. And so some perspective is we do think, as we stated in the last couple of Matt's Minutes, we do think we're going through and experiencing a correction. And a correction is temporary, not permanent. It certainly will feel better if we come out of the correction. But a correction is a dip of 10% from the highs when you look at the broad market. So we are in that territory depending on the market and the index you look at. That does not mean the sky is falling. It does not mean we should absolutely cash everything in and retreat to safety. There's still things lining up that show 2019 as a positive year. Our crystal ball, if we had to put one out there, does say that for a number of different reasons that sometime in 2020, that would be the time that we think recession could come into play. And so what we want to do is we want to keep, there's a plan, we want to keep transitioning a little bit away from the higher number of individual stock or securities that you have, and we want to keep moving and pivoting, transitioning almost to more of a broad-based holding, where we're going to basically bring up some of the lows and bring down some of the highs. And you know, a good analogy would be a roller coaster. You can ride a roller coaster all day long at Cedar Point, and if you get to the end of the ride and it worked and it was great, but you want to throw up, that doesn't mean that that was a success. So we understand that even if we get through this correction and everything turns around, it doesn't mean you didn't want to throw up along the way. And so we want to basically do everything we can to remove that. But that doesn't mean blowing everything up in the portfolio on one day. There's a plan, there's a transition, and we want to help you get you down that path as we move further into the year 2019 and ideally in advance of 2020. So if you have any questions, we are always here for you. You can call or email questions@richmondbrothers.com or call our office at 517-435-4040 and let Sally know who you might need to talk to. And if we need to set meetings or phone conferences with anyone in the office, we're more than happy to do so. So with that in mind, we'll be back maybe shorter than the next month. We'll see how the next couple of weeks go. But by and large, we just wanted to let you know that we understand, we see it, we feel it for you. We don't think that the sky is falling, and we're not aggressively acting to reduce equity positions at this time because of that sentiment. GDP is still really strong. Holiday shopping and spending is really strong from consumers. Early indications coming out of post-Thanksgiving are very strong. Where consumers spend money is a very big indicator of economic expansion or contraction, and all of those signs point to continued expansion. So again, let us know if you have questions. We really appreciate having the opportunity to serve you. And this is Matt Curfman with Richmond Brothers signing off for Matt's Minutes. Thank you for tuning in.